When the US stock market hit new highs, the last two pieces of the puzzle suddenly made their moves, which means it's time for the end. What's the most horrible movie in this world? It's not Sadako or anything like that. It's history replaying the exact same script right in front of you. We've already seen this story. We lived through how disgusting the ending was. Yet, we still believe this time will be different. But the second time, the third time, the countless times, you still fall into the same trap. What do I mean? Hello everyone, I'm Money Zen. Back in 2006, when real estate prices were soaring, a man whose appearance didn't fit in at all walked into a Wall Street bank. Calmly, he told the suit-wearing bank manager in front of him, "Please structure a bet-on agreement for me. I want to bet $100 million that your bank will go bankrupt, and I want to bet the US real estate market will crash." The manager froze. He glanced at his colleague beside him, exchanged a look with some absurdity, pity, and the kind of smirk you give an idiot, then replied, "Sir, do you know how insane the housing prices are right now? The whole Wall Street is making endless money from this. You are biting off more than you can chew." The man said nothing, quietly took back his documents. The manager thought he finally woke up, but a few days later, the man returned with an even thicker documents, and he went over all the top Wall Street investment banks. With the same condition, he signed a total of $1.5 billion worth of the same bet all in once. When he walked out of the last bank, the elites behind him couldn't hold back their laughter because they thought it's the easiest money ever made in Wall Street history. And the idiot who signed those contracts was Michael Burry, the same idiot they later made into the movie The Big Short. At the same time, a bank called Deutsche was selling clients a guaranteed profit financial product, while secretly betting the market would crash. 2 years later, a full-blown financial crisis erupted, and while countless people saw their wealth wiped out overnight, these two capital became the real winners. And now, take a deep breath, because after holding back for 17 years, these two people just made their move again. The Big Short, Michael Burry, takes 80% of his entire net worth out, borrowed massive amounts of two US stocks. One is called Nvidia, the other one called Palantir, and started dumping them aggressively. And these two stocks, they're the ones that have skyrocketed the most over the past 2 years. Which means, if Nvidia and Palantir's stock prices keep surging higher, the Big Short will be wiped out instantly. At the same time, Deutsche Bank has also begun shorting AI stocks, saying it's for hedging risk because they've created a financial product that looks identical in 2008. What does that mean? You're gonna find out. The exact same script from back then is being replayed today. The topic we discussed today isn't about US stocks, the economy, not AI bubble or something like that. But just like back then, these new assets are being carefully packaged, stamped with a safe label, and sold to the whole world again. And they're basically the nuclear weapons of the entire financial system. So what does it mean when the prophet of the last financial crisis and the architect behind it both make their moves at the same time? Before we get into that, to make sure we're all thinking on the same page, let's unify our language first. Some people might say, "Money Zen, you've been talking so much, but even if US stocks crash, they bounce right back. The things you're predicting will never happen, right?" But here's the problem. You will realize, from our investors' point of view, aside from the market crash in April this year, the US stock market hasn't really done anything wrong. It surged, plunged a bit, corrected a bit, and then bounced right back again. It still looks incredibly strong, so we can get a conclusion. The US stock market is strong, but can that really be used as evidence for reasoning? Put it more simply, before the 2008 crisis, the real estate market was also skyrocketing, but that didn't mean anything. We couldn't say, because housing prices are rising, so that we can infer the housing prices will keep rising in the future, or they've already at the peak, and a financial crisis is coming. There's no logic in that. So if you say the US stocks are strong, means the economy is strong, but the US dollar and US treasuries, they've already been in a long bear market. No one wants the dollar. No one is buying US treasuries. So can we infer the conclusion that the US is actually crashing? So in the end, is the US doing good or bad? Can you get it? No matter if it's US stocks, US dollar, or US treasuries going up or down, all it affects is our investment strategy. For example, for me, it's because the US dollar is in a bear market. So I don't invest in US stocks. I invest in gold, silver, which are in a bull market. This is called investment strategy. If you don't mind the bear market of the US dollar and losing money on the exchange rates before you even start investing, as long as you believe your profit in US stocks will exceed that currency loss. It's also called investment strategy. But that has nothing to do with what we're talking about today, because these things are not evidence. All reasoning must be based on evidence. So what counts as evidence? Today, I'm putting the evidence, facts, and outcomes from 2008 right in front of you. And I'm putting today's evidence, facts next to them so we can do a compare. Hope we can work together and complete a reasoning that could mostly happen and closest to the reality. If you don't want to become a victim this time, or even wants to climb to a higher class, then you could subscribe to my channel, because I'm gonna be giving you more information like this. And if you are worried, you'll forget everything after hearing it, and you don't want to waste your time, you can like this video, and it will be automatically saved in your playlist, so you can come back and follow it anytime. First, before the financial crisis, the Big Short, Michael Burry, what exactly did he see? Let's not talk about those boring and complicated data. Straight to the key point. If we want to buy a house today, we need a down payment, right? And the bank needs to see that we have a stable job, income proof, then so that they'll lend us money for the house, right? But don't misunderstand. It's not because we don't have jobs or income that the bank refused to lend us money. It's because the law requires them to check your proof of income. Why? Because before 2008, there were no laws, no rules at all. What does that mean? Imagine you're a real estate developer today. What do you want? You want more and more people take the load to buy houses, right? And with the continuously rising of housing price, you can sell your houses faster and higher, okay? What about banks? If there's more people buying houses, more people will come to the bank for borrowing mortgages. So the bank's business is getting better and better. And with the continuously rising of housing price, all the houses mortgaged to the banks become more valuable. A lot of people think the house they bought is their biggest asset. It's actually not. As long as you bought it with a mortgage and used for self-living, that house is actually the bank's asset. Because you put it as collateral with the bank, it belongs to the bank. If you can't repay the money, the bank could just sell it and kicks you out. So the house is bank's assets and your liability. In other words, the more people borrow mortgage, the more houses are pledged to the bank, and the more assets the bank holds. So do you think the banks want housing prices rise or fall? So actually, for the capitalists of real estate and bank, their interests are aligned. What they need to do is to push up the housing price and get more people to buy houses. So they sat together and came up with a risk-free money-making plan. How they do it? There are only a small group of people in this world are rich people and middle class. 3% of the people hold 90% of the world's wealth. If houses can only be sold to these people, then housing prices can be pushed up. So they set their sights on the poor. You don't have a job today? Actually, that's fine. As long as you occasionally do some part-time work, the bank will count that as your income. How much you earn doesn't matter. As long as you have income, I can lend you money to buy a house. You don't have a single dollar of savings. Also, okay, I'll lend you the money first, and you use that to pay me the down payment. This way, you can apply for a mortgage, and the money I lend you for the down payment actually never leaves my hands. So simply put, you don't have to pay a single cent, and the bank lends you the money to buy a house. Pretty nice, huh? That's why back then, in the US, even homeless people and the prostitutes had 10, 20 houses under their names. And because of that, everyone rushed to buy houses. Housing prices didn't just keep rising, but skyrocketed. But here comes the problem. If these poor people can't pay back the money, one of the loans that bank lends out becomes bad debt and can't take it back. No worries. Because the bank can sell the houses that these poor people mortgaged, I lend you 1 million. You can't pay back. When I sell the house, the price have gone up to 2 million. The bank earns an extra million. So if you repay, the bank earns interest. If you don't repay, the bank earns from rising house prices. Even better. But this game still has a bug. If it's only one or two poor people who can't repay, not that bad. But if a large group of poor people can't repay at the same time, no one is buying houses anymore. Housing prices drop and the foreclosed houses can't be sold, then the bank will fail. And this game has a ceiling. Let's say my bank only has $10 billion. Once I lend out this whole 10 billion, I can't continue doing business anymore. And since I lent all the money out, there's no money left in hand. If accident happens, I don't have money to turn over. So what to do? Simple. Just shift the risk out and take the money back. Put it simply, I lend 10 billions out today. I can collect 7% interest back every year. Okay, I turn this debt to a wealth management product. Sell it directly to Wall Street's investment bank. Let the investment bank pay me 10 billion today, and I pay you 5% interest every year. So instantly, I get my 10 billion back and earn an extra 2%, and I can continue to lend this 10 billion out again, right? But the problem is, why these investment banks from Wall Street would buy this debt from me? First bank deposit rates back then were close to 0%, which means if Wall Street kept money in the bank or bought US treasuries, they couldn't earn any interest and would even lose to inflation. But in their asset allocation, they must buy some lower risk assets to hedge against risk. And the risk of the debt I sold them is very low, even though these debts look terrible and probably can't take it back. Because these homeless people and prostitutes have unstable income and might not pay back the money. But the housing prices were rising, as I just said. The mortgaged houses can always be sold. So they're not afraid they can't get the money back. That's the first point. Second, the bank mixes these bad debts with other good debts, and that becomes MBS. Simply put, I may be selling you the mortgages of 10,000 homeless people, but I'm also selling you Bill Gates' mortgage. You're worried. Homeless people can't repay, but Bill Gates won't default, right? So Bill Gates mixed it together with 10,000 homeless people, turn in a bundle of debt sold to you. The risk of default is hedged, right? So the bank mixes these good debts and bad debts and turned them into an MBS bundle, sold it to the investment bank. The money got back and the risk is shifted away. Once these homeless borrowers default, the ones chasing the money are no longer the banks. It's the Wall Street investment banks bought these MBS bundles. After hearing all this, do you really think Wall Street will be the ones paying for the bills in the end? Back then, after Deutsche Bank bought these MBS bundles, they also took some student loans, commercial loans from the market, and mixed them together. These were considered as high-quality loans too, because students who made it into college usually have better jobs than ordinary people. Their ability to repaying is stronger. So simply put, Deutsche Bank took these original MBS mortgage bundles, mixed in even more good debt, and turned them into an even more complicated structured bond. But still not enough. Then they went to ratings agencies like Moody's and the S&P and asked them to rate AAA, the highest rating, and the final goal, to sell these structured bonds to ordinary people, to let ordinary people take on all the final risk. Like an ordinary person walks into a bank. Fixed deposit basically has no interest, but the bank manager will tell you, we're working with an investment bank. There's a financial product rated the same as government treasuries, also AAA, but it pays higher interest than treasuries, probably 3%. So would you buy it? Banks might fail, but the US won't fail, right? And since these structured bonds is rated the same as US treasuries, it must be extremely safe. And if you still think the risk is high, no problem. We even prepared an insurance for you called CDS. If these homeless people, these poor borrowers, really can't pay back, don't worry, the insurance company will pay you on their behalf. They will compensate you. Isn't that 3 or 4 layers of protection? And with the bunch of sales talk, Deutsche Bank sold all these structured bonds to ordinary people. And who insured all these structured bonds? Lehman Brothers. And we all know what happened next. Massive amounts of homeless started defaulting. Housing prices plunged. Other homeless saw housing prices falling so badly, so they also stopped paying. So housing prices fell even harder. Most Americans who bought houses got trapped. The economy crashed. The banks, they sold these bonds out. Banks sold them to the investment banks. the investment banks? They sold these bonds out too. Investment banks sold them to the ordinary people. And ordinary people, they bought these bonds. And now no one was paying them. So they went to Lehman Brothers to claim their insurance. And then Lehman Brothers went bankrupt, already shut down. How could they compensate anything? At that moment, the government stepped in, took out bailout money, and paid it out. Paid to who? Ordinary people. Of course not. It was paid to Lehman's executives, the capitalists. So who finally paid for all of this? The banks? The investment banks? Lehman Brothers? No. It was the ordinary people of the world. If you bought these structured bonds, of course you lost money. If you didn't buy them, your house lost money for you. If you didn't buy a house, your stocks lost money for you. If you didn't buy stocks, well, sorry, your boss did. Your boss loses money, goes bankrupt. You don't even have a job. And these capitalists, not only did they get compensated, the Federal Reserve even cut rates and printed money, lent them money so they could bottom fishing the assets that ordinary people were forced to sell cheaply. So what was the fuse for the 2008 financial crisis? What's the evidence? It wasn't the soaring housing prices. It was that capitalists invented a structured bond, packaged it, and sold it to ordinary people. All the risk was pushed onto ordinary people, and all the profit flowed into their own vaults. And now, after the 2008 crisis, although banks were restricted by the government, they can't package and sell subprime loans anymore. But private equity firms can. The ones playing with fire now aren't the banks anymore, but these shadow banks, and they look even safer, more legal, and even more profitable. What do I mean? Here's the main point. Take Meta, for example. They want to build an AI data center to develop AI. How would they do it? Step 1. Get something for nothing. Building an AI data center costs astronomical amounts. So you'll notice, none of the AI giants pay with their own money. If they did, they'd have a massive liability. Their financial statements would look terrible, and their stock price would plunge. So they all go to shadow banks and say, you build a data center for us. After you finish, we'll rent it long term and pay you sky-high rent every year. But here's the problem. These shadow banks also don't have that much money. But no worries. They hold long-term leases signed with AI giants. So we comes to step 2. Risk transference. The shadow banks take the lease, issue bonds to investors around the world, and tell them these bonds are guaranteed by Meta and other AI giants. Profit guaranteed and risk-free. Annual interest 7 to 10%, much higher than bank deposits. Investors hear that, and they are instantly tempted. They pay the money, and that's how the funds are raised. This is the so-called SPV now. For AI giants, they could not only get to use the data centers, but also don't need to spend a cent of their own money. No huge liabilities in the financial statements, and their stock prices keeps flying. Shadow banks also don't need to spend their own money, but they earn the rental difference in the middle, and all the risk ends up on the investors who buy those bonds. It's like a borrow someone's chicken to lay your eggs game. The tech giants borrow someone else's chicken to lay golden eggs for themselves, and the cost and the risk of raising the chicken are all on others. But here's the question. How big is this game scale? We saw Meta, this one company alone, plans to invest $600 billion into data centers. What if you add Google, Microsoft, Amazon, the entire Magnificent Seven? The scale was trillions of dollars. If this game collapses, the crisis it triggers will be 10 times bigger than 2008. And here's another question. If it really collapses, who pays the bill? AI giants, shadow banks, or the investors? At that moment, the ghost of 2008 returns. Deutsche Bank steps in again, collects all these AI data center bonds, performs the same packaging magic as 2008, mixes them with other assets, slaps an AAA ultra safe label on them, and turns them into an invincible looking financial product. And in the end, of course, sell them to ordinary people around the world. After hearing all this, you might say, but I've never bought anything like that. Right, not only have you not bought it, you probably have never even heard of SPV. But sorry, think back. Have you ever given money to someone to invest for you? You probably don't even remember. Because pension funds and insurance have become such normal expenses for most people. which means pension funds and insurance companies took your money and used it to buy these AAA financial products. Meaning, ordinary people's pensions and insurance may have unknowingly bought these beautifully packaged bombs. And you may think, how can these be bombs? Back in 2008, only the poor bought houses. But this time, it's different. It's all AI giants, right? Homeless people might default, but Bill Gates won't, right? Here's the crucial one. This entire game is built on one assumption. As long as these AI giants continue developing AI, they must keep renting these data centers. And AI companies now have no liability, full of money. So, of course, they can't default, right? But what if the speed of AI profits can't catch up with the speed of the expense? What if one day these AI giants find out that tearing up the lease is cheaper than honoring the contract? Take the most successful OpenAI as the example. It already has 1 billion users, which is super strong. Basically, almost all internet users with spending power are its customers. But from another angle, that also means it's very hard for it to keep growing its customer base. Let's be optimistic and assume that 3 years later, its customer base can somehow double and its revenue skyrockets 10 times compared to now. So how much money can it make? $100 billion. But do you know how much money this company has to spend to invest in AI? $1.4 trillion, meaning this company is at a surprising pace to spend all the money it earned. With $1 earned, $14 spent. So tell me, compared with those homeless back then, is its ability to repay actually any different? And this is already assuming its revenue can grow 10 times. Now in the AI industry, everyone is open sourcing free models. Lots of AI tools don't even charge anymore, so what then? And companies like Nvidia, Oracle, their valuations do look very profitable. But like I said in previous videos, they are playing self-reinforcing capital recycling loop. I give you money, you buy my products, and I help you to buy your products again. The money just goes in a circle without actually increasing, but everyone's products were sold. Also, the financial statements look great, and the stock prices go up too. Then they use their stocks as cash to spend, meaning their wealth only exists as long as their stock prices keep rising. Isn't this the same as housing prices in 2008? It's fine as long as it goes up, but when it falls, do you think these AI giants wouldn't tear up their leases? And if all this, some people might say, I'm just overthinking it. Fine, let's pretend we didn't see anything. But everyone, are data centers and real estate even the same collateral? A house is still there even if the price drops, but AI servers and chips, today's compute chips have a typical lifespan of only 3 to 5 years. Meaning, the compute centers you build for trillions of dollars is basically turtles in front of the new chips come out 2 years later. In other words, the data centers that AI giants are renting today are rapidly depreciating. So when the market gets cheaper and more efficient, compute 2 years later, will these AI giants still honor the contracts, still pay high rent for your obsolete data centers? Which also means that even if AI is not a bubble, even if stock prices keep rising, even if AI really becomes profitable, none of that matters. Because to put it bluntly, it's actually ordinary people are paying for AI giants to build data centers now. And these data centers will get replaced in a year or two. They'll be obsolete. It's basically like, you pay me to build a house, I pay you rent. But in a year or two, your house becomes unlivable, and I just go find someone else to build me a new one. So when that time comes, who's going to foot the bill? The AI giants? They're just renters, shadow banks. I already sold the debt to you. And who are you? Pension funds, insurance companies, and ordinary people. From the US to the UK, from Japan to Korea, countries have already approved pension funds to invest in these types of assets. So now, everyone can rest assured, whether you bought their bonds or not, whether you can receive your future pension, they get to decide. A lot of people think AI giants can be trusted, but I'm not sure if they can be trusted. It's objective. What I saw is, they already cut themselves loose from these bonds long ago. When things blow up, the ones who need to pay the bills above won't be them. And when the crash comes, the Fed printed money lends to who? Who gets to buy the dip? Didn't 2008 already give us the answer? If you have a better understanding or better logic, welcome brothers and sisters who have a different opinion. Feel free to leave a comment down below to discuss with us. Due to time constraints, I have to end here. But what do you anticipate in the next episode? A lot of people are waiting for this line every week. It's gonna be a crucial one. Alright, I'll continue sharing tips on how to become wealthy, how to be an entrepreneur, an investor, and achieving financial freedom every Sunday at 8:30 p.m. If you don't want to miss out, make sure to subscribe to my channel and click the little bell and generously share this video. I sincerely wish all of you who like this video will reach financial freedom soon. As long as you can find one or two useful sentences in today's content that can help you live a better life, I'll be completely satisfied. Alright, I'll see you next week. Bye!